Good afternoon. My name is Guy Bukovsky, and today we're going to learn all about monetary policy. Monetary policy is the process by which the monetary authority of a country, in Canada it's the central bank, in the States the Federal Reserve, controls the supply of money, often targeting an inflation rate or interest rate to ensure price stability and general trust in the currency. We're going to be talking about three key ideas today: inflation, the central bank, and how the central bank tries to affect inflation. Now, what is inflation? Inflation is the change in the purchasing power of a given unit of currency over time. Inflation is the reason why your grandparents used to be able to buy a candy bar for 5 cents, and why tuition prices are so much higher now than they used to be. The output gap is how we gauge inflation and where the country is in terms of hitting its targets. The output gap is the difference between actual output, or GDP, and potential output, which is GDP at maximum efficiency. Actual output is statistical, via data collection, while potential output is estimated, based on the resources of the country and employment variables. If actual output is greater than potential output, then we are underutilizing resources. Demand, price, and the inflation rate all fall. This is called a recessionary gap. If actual output is less than the potential output, we are overworking resources. Demand, price, and inflation rate all rise. This is called an inflationary gap. The central bank, Canada's monetary authority. Now, the Central Bank of Canada performs four basic functions. It manages the money supply, acts as the banker's bank, acts as the federal government's fiscal agent, and helps supervise the operations of financial markets to ensure their stability. The central bank is responsible for predicting the rate of inflation and attempting to keep it between a set of acceptable values, or an inflation control target. In 1991, the central bank and the federal government agreed to attempt to reduce inflation from 5% to 2%. By 1995, 2% inflation is reached. The new goal is stable, consistent inflation in order to maintain healthy growth over time. Since then, the inflation control target has been extended 5 times, most recently until the end of 2016. The process. How does the central bank affect inflation? Policy interest rate. Policy interest rates are a change in bank-to-bank interest rates in order to affect non-bank interest rates. If the Bank of Canada wants to slow inflation, it must slow the borrowing and spending of money that is helping the economy grow. It does this by raising interest rates. If the Bank of Canada wants to induce inflation, it must increase the borrowing and spending of money in the economy. It does so by lowering the interest rate. But say you bank at TD. Well, how does this affect you? Commercial banks are always trading large sums of money with other large financial institutions. The Bank of Canada is responsible for lending these commercial banks the money that they use in day-to-day operations. It does so at a rate called the policy interest rate, which is determined 8 times a year. If the Bank of Canada wants the overnight or short-term interest rate to be at 4%, it will loan to banks any sum of cash at 4.5% interest, and it will accept deposits at 3.5% interest. Banks and other financial institutions will have to set their interest rates in between these rates in order to stay competitive and viable, making the actual overnight interest rate approximately 4%. Now, there are 2 types of inflation control: extractionary and contractionary. Extractionary is when we increase the money in supply, lowering interest rates. This results in an aggregate demand shift to the right due to an increase in investments and consumption of goods. This leads to inflation. Looking at this graph here, we can see that aggregate demand, or AD1, was shifted to the right, which shows an increase in price level per product. This is when the policy interest rates went down, causing the overnight interest rates to go down, increasing business investment, operations, employment, wages, production, spending, demand, prices, and causing inflation. This is used to end a recessionary gap in the economy. This method can be used to lower unemployment and help private sectors boost borrowing and consumer spending. The other type is contractionary. This is decreasing money in supply while raising interest rates, resulting in aggregate demand shift to the left due to a decrease in investments and consumption of goods. This leads to deflation. Looking at this graph, we see it's the same thing except the aggregate demand was shifted to the left. The policy interest rates went up, overnight interest rates went up, business investment, operations, employment, wages, production, spending, demand, prices went down, and it slowed inflation, maybe even leading to deflation. This can be used to end an inflationary gap in the economy. The downside to this method is that the results of implementing it can slow economic growth and increase unemployment levels. Looking at this graph here, we can see that when GDP is low, the central bank induces inflation by lowering interest rates. The area shaded blue is the policy interest rate set by the Bank of Canada. The dotted line is the Canadian GDP annual growth. We can see that when GDP goes down, the Bank of Canada tries to induce inflation and inject money into the economy by lowering the interest rates and hoping that more people will borrow and spend money. The limitations of monetary policy are mostly seen in underdeveloped countries. For instance, they have a large non-monetized sector that relies on the barter system to trade goods and services. Or they have a lot of foreign banks which aren't affected by that country's monetary policy. A lot of banks in these underdeveloped countries have high liquidity, meaning that their money is stored in stuff that can be sold very easily, like stocks or saving bonds. Another issue is that a lot of well-off people tend to use alternatives to banking instead of banking. What they do is buy a lot of jewelry or gold or stocks that can be sold instead of giving their money to a bank.
That's all, folks.